Hello and good afternoon, and welcome to this webinar, which is all about self-assessment essentials for sole traders. My name's Emily Coltman. I'm FreeAgent's Chief Accountant, and I'm here to spend the next half hour or so taking you through some essentials of filling in a tax return if you are a sole trader. A few points of housekeeping. I'm going to be using my FreeAgent account to illustrate and to demonstrate what happens in a tax return, but what I will say is this is not going to be a sales pitch for FreeAgent, nor is it going to be about strictly how to use FreeAgent, how to do your books in FreeAgent to prepare your tax return. We have got a webinar about that next week, on Thursday of next week, which is Thursday the 23rd of January. So you're more than welcome to come to that Thursday the 23rd at midday. Please sign up on our website if you are interested. In terms of today's webinar, unfortunately, I can't take any questions from the floor because there's quite a big audience. If you do have questions about how to fill in a tax return, there's lots of useful information on our website. There's a blog with frequently asked questions about completing a self-assessment for sole traders. There's guides as to what expenses you can and can't use to reduce your tax bill. All manner of useful information that you can find on freeagent.com. And we will be sending a recording of this webinar to everybody who's registered, hopefully within the next few days. Also, just in terms of what help our support team are allowed to provide to you, they can only help with using FreeAgent. They can't answer general queries about how to complete a tax return, simply because HMRC doesn't let them do that. So if you do get in touch and they say that I'm afraid I can't answer your question, that is because HMRC don't let us give tax advice. Okay, so let's get stuck in and talk about self-assessment for sole traders. If you're a sole trader who started your business anytime before the 5th of April 2024, then you can expect to be filling in a tax return for this tax year in question, which is the tax year, as you can see, that runs from the 6th of April 2023 to the 5th of April 2024, the filing deadline for which is the end of January 2025, so that's the end of this month. What you need to put on your tax return is not just the information about your business's income and costs, which HMRC, that's HM Revenue and Customs, aka the taxman, don't yet know about. You need to include on your tax return all your taxable income, because the purpose of a tax return is to give HMRC a picture in the round of all of your taxable income and anything that you might possibly have to get a bit of tax relief. Tax relief, by the way, refers to being able to save tax. That might be reducing the income that you pay tax on, or it might be reducing the tax itself, but tax relief is all about reducing a tax bill. All tax returns have basically the same layout. You start with what we call the main return, sometimes called the SA100 form. And what that contains is some of the most typical types of taxable income and some of the most common tax reliefs, like pension contributions or donations to charities through gift aid. You then have what we call sets of supplementary pages. So that might be employment income from a job, self-employment. As a sole trader, you're going to have that. That will be reporting your business's income and costs. If you also rent out a property, you'll have property pages. There might also be other pages that you can't see here, things like capital gains income or income from a trust or income that you earned as a minister of religion. Basically, if you've got a separate source of income, then you need to either put it on the main return or do a set of supplementary pages for it. If you've got more than one of any type of income, for instance, if you've got two jobs, you would do two sets of employment pages. You don't add the two sets of income together that you receive from your two jobs. You report them as separate employments by doing separate sets of employment pages. A tax return, as I said before, always covers the tax year. You might also hear that called the fiscal year. 6th of April 2023 to the 5th of April 2024 is the one we're interested in right now. Shorthand for that is 2023 to 24. That is how I might well refer to it as we go through this webinar. What I propose to do today is give you an overview of some of the key questions and fields that you might have to fill in on the main return. Do the same for the employment pages, but spend most of it talking about the self-employment pages, because obviously you are all sole traders here, and that is kind of the key area to focus on. So without further ado, let's have a look at the main return. 9 times out of 10, when you fill in a tax return, you're going to be reporting that source of income for the fiscal year, and you will often find that you get that information given to you for the correct period. For instance, if you've got income from a job, your employer will give you what's called a Form P60, and it will be a Form P60 if you were still employed by that person as at the 5th of April 2024. If you left the job during 2023-24, it's a P45 you'll get, but it will be always for the tax year, or if it's a P45, it'll be up to the point within the tax year that you left that employment. But the key point I'm driving at there is you will get that information for the tax year. Your employer won't expect you to work it out by adding up 2 different years together, 2 different calendar years or anything like that. And if you've got interest income from a bank, they'll do the same. They should give you the interest information for the tax year in question. Let's dive in and have a look at some of the key boxes on the main return. Which tax rates are you subject to? English and Northern Irish, Scottish or Welsh? What that depends on is whereabouts in the UK you live. Not the part of the UK you identify as coming from. Where do you live? Where are you typically resident, or where were you typically resident during 23-24? You can probably tell from the way I speak, I'm English, born and raised in England, but because I live in Scotland, I actually count as a Scottish taxpayer, not an English one. So you need to be careful to choose the right tax rates so that you're taxed at the correct rate on your income. Let's have a look at some common areas of taxable income. Bank interest. You might well receive interest on a bank account, but even something as simple as that, there's a few ifs and buts. Always the income for the tax year you need to report here, as I say. Check to see whether or not your bank has taken tax off the interest before it gave it to you, because they don't always. Sometimes they do take tax off, sometimes they don't. Check your interest statements or your bank statements or your banking app for more information about that. And make sure that you put the interest in the right box, whether you have already had tax taken off or whether you haven't. Always for the tax year, as I say. Remember that this is your personal income, your personal interest. As a trader, you're unlikely to have a bank account that isn't in your personal name, because you and your business are not legally separate. If you happen to also operate a limited company, then the company's bank account, the interest on the company's bank account, has to stay off here, because this is your tax return, not the company's. But being a sole trader, the bank account that you have for your business will be in your own personal name. So you take the bank interest that you received on that account and you put it in here. Put it on your main return, not on your self-employment pages. If this counts as your own income, you've got to report it here. If you have a joint bank account with a spouse or partner, it's your share that goes on here. It's usually a half share. So if you have a bank account that's a joint bank account with your spouse or your partner, put a half share of the interest onto your tax return. Remember as well that the tax return reports taxable income. Any interest that you earn from an ISA is not taxable income, therefore you leave it off your tax return completely. Don't put it on. Don't make the mistake of putting interest on an ISA into box 2 here. There is a difference between interest on which you do have to pay tax but haven't done it yet, which would be untaxed UK interest, and interest on which you do not have to pay tax, like an ISA. So just be careful which type of bank account you've got. If you're in any doubt as to what type of bank account you've got, check with your bank. If you're not sure whether or not your bank interest should be reported on your tax return, speak to HMRC or speak to your accountant. Fill in the pension section if you received a pension, or if you've got tax relief to, excuse me a moment, I've been out of there for too long. Or if you've got tax relief to claim on contributions that you made to a pension, then where those would go would be here. So you see, I've got some questions about, did you pay into a registered pension scheme? If you're a sole trader and you're contributing to a pension scheme, then you're going to claim some tax relief. Put the contributions that you made into that box here. 9 times out of 10, sole traders' pension contributions would go in there. If you've made any donations to charity under gift aid, they go in here. If you're paying tax at more than the basic rate of tax, which is 20% south of the border, and I believe it's 21% in Scotland, though I may be wrong, you would put those donations in there and get yourself some tax relief. If you're repaying a student loan or a postgraduate loan, remember to fill in these boxes here. That's important because when you're a sole trader, if you don't also have a job, you won't be actually making any student or postgraduate loan repayments unless you fill in these boxes on your tax return. That, as a sole trader, is what you are supposed to do. Do your student loan repayments through your tax return. They get collected along with your tax. Marriage allowance, transfer or receipt. What this is about is if you are married or you're in a civil partnership, one of you is a non-taxpayer, which usually means your income is under the personal allowance threshold, that's £12,570, and the other is a basic rate taxpayer, then the non-taxpayer can give a little of their personal allowance to the basic rate taxpayer in order to reduce a bit of the tax they pay. If you want to do that, you need to apply through HMRC's website, and then you or your partner, whichever is the basic rate taxpayer, could save a bit of tax. What I'm going to do now is to move on to some of the supplementary pages. The employment pages, as I mentioned, so I've set up some dummy employment pages so that you can see what I mean. You'd get a P45 or a P60, as I mentioned earlier, and you would fill in the pay and the tax taken off according to what it says on your P60 or your P45. See there, I've got the option to add an additional employment. That's what I was talking about. If you've got more than one job or had more than one job during the tax year, you do need to put in a set of additional employment pages for each job that you had. If you received benefits, if you got a Form P11D, you would need to say yes to this question, and you would need to fill in what went on your Form P11D. The reason for that is that if you have had more tax taken off your salary than you would have done without a taxable benefit, say your employer pays for private medical insurance for you, you will pay a bit more tax and have it taken off your salary than you would have done without the private medical insurance. So if you don't, on your tax return, tell HMRC about your salary and your private medical insurance, they'll think you've paid too much tax and they'll give you some of it back. What's the problem with that, I hear you say? The problem with that is that HMRC will eventually realise they've made a mistake. They'll ask you for your tax back, and they may well charge you interest as well. Just be careful. By the way, as a sole trader, you would only need to fill in the employment page if you also have a salaried job in addition to your business. Your business's income and costs, or any money that you personally take out of your business, does not go on these pages. Any income and costs that your business earns goes on these pages, self-employment. If you're a sole trader, you are self-employed, the terms mean exactly the same thing from a tax point of view. You do not have an employer, unless of course you have another job. You are your own employer, effectively. You are self-employed. You and your business have no legal difference between them. So what, as a sole trader, you will pay tax on is your business's profit. Your business's profit is its income less its day-to-day running costs. However much you personally withdraw from the business is actually irrelevant from a tax point of view. Theoretically, you could empty your business's bank account and HMRC won't mind in the slightest, because there's no legal separation between you and your business. You don't have to tell HMRC on your tax return how much money you personally have taken out of your business. They don't care about that when you're a sole trader. They do if you're operating a limited company for your business, but not if you're a sole trader. When you're a sole trader, what you need to do is you need to tell HMRC all about your business's income, and you tell HMRC all about any day-to-day running costs your business had. Then you work out your profit, which is the difference between the two, and that is what you're going to ultimately end up paying tax on. Now, I'm gently scrolling through this page, and you'll see there's rather a lot of sets of information here. Lots of different boxes showing sales and costs. Lots of different profit figures. What is going on? What is going on is something called basis period reform. What do I mean by basis period reform? If you're a sole trader and you've been in business for a few years now, and you chose a date to draw up your books to every year that's called your accounting year end, that was not the tax year, or by concession the 31st of March or anything between the 31st of March and the 5th of April. If, for instance, you are drawing up your accounts to the 31st of December every year, what you would have been doing in the years up to 2022 to 23, you would have reported on your tax return your business's profits for the accounting year that finished within the tax year. So suppose you had a 31st of December year end. In the tax year 2022 to 23, assuming your business had been ongoing for a few years, what you would probably have reported, or what you should have reported, I'm 90% sure, would have been your business's income and costs for the calendar year 2022. That's because the 31st of December that fell between the 6th of April 2022 and the 5th of April 2023 is the 31st of December 2022. So you would probably have been used to reporting your figures for the accounting year on the self-employment pages. But come April 2024 to 25, come the tax year that we're in at the moment, everybody's got to report their profits for the tax year. All sole traders have got to report their profits based on these dates here. And 2023 to 24 is what's called the transition year, where a business will move from paying tax on its profits for the accounting year to paying tax for its profits in the tax year. That means some quite complicated calculations to do. I promised this wouldn't be a sales pitch for FreeAgent, but I'm just going to mention in passing that what FreeAgent is doing here is taking all the figures that I've put in for things like invoices, bills, bank transactions, out-of-pocket expenses, and it's actually working out the correct dates for me for basis period reform. It's saying, okay, as at last year, you paid tax on your profits up to the end of January 2022. We're going to put in a slightly longer period this time round so that you're going to pay tax on your profits up to the 5th of April 2024. Then we're going to go forward from there for 24-25. There's a whole lot of rules about how you've got to break that down. You also don't have to pay tax on all of that at once. You pay tax on the first 12 months worth of that, so up to December 23, and then you're allowed to spread the profit for the period from 12 months after that date to the 5th of April 2024. You can spread that forward over up to 5 years. And you can see FreeAgent is doing that for me. It's spreading that forwards. I'm not going to go into huge amounts of detail about that. What I will just say to remind you is this only affects basis period reform, all these extra calculations, only affects you if your business does not draw up its accounts to the 5th of April every year. If you draw up your accounts to the 5th of April every year, which a lot of sole traders do, you do not have to worry about basis period reform. You just go on as you always have done. But I wanted to cover basis period reform just briefly for the benefit of those sole traders who don't draw up their accounts to the tax year end. So that's just something to bear in mind. What I'd also like to highlight is national insurance, Class 2 national insurance. There's been a lot of changes to Class 2 national insurance in the last few years. Successive governments have made a few changes to that. How it works for 2023 to 24 is if your business has made a profit of under £6,725, you can choose to pay Class 2 national insurance voluntarily. Why would you do that? Because it protects your entitlement to state pension and other tax benefits in later life. You have to have paid national insurance for so many years in order to get a full state pension. If your profits are small, you might choose to pay Class 2 national insurance anyway in order to make sure that this is what we call a qualifying year for state pension. If your profits are between that threshold and 12,570, then you are actually treated as if you had paid Class 2 national insurance. In other words, it will be a qualifying year, but you do not actually have to pay Class 2 national insurance. You do not have to pay at all. In fact, you can't. I've known people who've tried to pay voluntarily when their profits fall between those two levels and not been able to. HMRC simply haven't accepted it because you are treated as having paid. If your profits are over the higher threshold, you've got to pay Class 2 national insurance, no questions. But I believe that from April 24 to 25, you will only even have the chance to pay Class 2 if your profits are under that small profit threshold. Anything bigger than that, everyone's treated as having paid Class 2 national insurance. Nobody actually has to pay it, and you can choose to pay it if your profits are below that threshold to give yourself a qualifying year. So I've talked very briefly there about one kind of levy, because national insurance, strictly speaking, isn't a tax. One kind of levy that you're paying on your income. What you're mostly going to be paying, so what we're looking at here is what we call a computation for how you work out how much tax and national insurance and student loan repayments you're going to have to pay. So you've got tax, the tax we're talking about is income tax. You've got what's called Class 4 national insurance contributions. Class 4 national insurance, you pay over and above the upper profit threshold, and Class 4 national insurance doesn't qualify you for any kind of state benefits. It's just basically something that looks very like an extra tax. As to why sole traders have to pay two different kinds of national insurance, I couldn't tell you. I honestly don't know what the reasoning is behind that. There was talk some years ago of whether those two could be amalgamated, Class 2 and Class 4, but it never actually happened. And as I say, you do also pay any student or postgraduate loan repayments through your tax return. That all then falls due by the end of January. So by the end of January, you must have filed your tax return with HMRC, and you've got to do it online now, unless you qualify for one of the few exemptions for filing on paper at this stage. Filing on paper can only be done by the end of October, so you've missed the train there. It's got to be filed online. You file it to HMRC online, that's one process. You must also pay any tax and national insurance due, and they've got to reach HMRC by the 31st of January. It's no good putting a cheque in the post on the 31st of January. You'll get charged interest for late payment of tax if you do that. HMRC have actually got to have the money in their grasp on the 31st of January for you not to get fined for late payment. What you've got to pay on the 31st of January is any tax and national insurance and student loans for this year. If you have more than £1,000 to pay, and also if you haven't already paid at least 80% of your tax due, what we call at source. In other words, you get the money after tax has been deducted, so like a salary. You get your salary from your employer after they've kept back some tax to pay to HMRC. If you haven't already paid at least 80% of your tax at source, you've got these beauties to pay, what's called payments on account. Payments on account are half of the current year's liability for income tax and Class 4 national insurance. So that payment on account there would be half of my Class 4 national insurance, those two figures there, plus income tax. And you need to be very, very careful. The first year you make these payments, you can see there that by the end of January, I've not only got the full year for 23 to 24 to pay. This is assuming that I made no payments on account in respect of 23-24. I've also got my first payment on account for 2024 to 25. So I've got a whopping great bill to pay by the end of January. That's not great at all. Payments on account, unfortunately, cannot be opted out of. You can't decide not to make them. If you have got a liability of over 1,000 and you haven't paid tax at source, and you don't file your tax return early enough in the year, which is by the 30th of December, to say that you want HMRC to take more money off your salary instead of charging you a big lump sum at the end of January, you've got to pay it by the end of January. So that's the balancing payment for this tax year. In other words, anything you still owe for this tax year, plus your first payment on account for next tax year, all due by the end of January. The second payment on account is due by the end of July. What then happens is if we jump forward to next tax year, so what we can see, if I go onto the tax page here, is that I have already paid that much on account for 2024 to 25. Those are the two figures you saw down at the bottom of the screen for 23-24. That then is set against anything I might owe for 24-25. What you see there is that for 2024 to 25, I didn't owe nearly so much. So HMRC will actually give me a refund if that is the case. If you pay more on account than you end up being due to pay, you get a refund. If you end up not quite paying enough on account, so for example, if that liability said £20,000 instead of £2,000, I would then be paying the difference by the end of January 2026. You can apply to reduce your payments on account. I'm just going to go back to 23-24. You can apply to reduce your payments on account, but I would not recommend doing that unless you are super confident that your liability next year is going to be less. For instance, if you know you've lost a big customer or you started to wind your business down to retirement or something like that. Be very, very careful about reducing your payments on account, because suppose I reduce them too far, I would actually end up being charged interest for late payment of tax. So careful with that. Always leave yourself a nice big margin for error if you do decide to reduce your payments on account or apply to. So that is a very quick whistle-stop tour of the tax return and hopefully some useful pointers to take for when you fill in your own tax return. As I say, you will be getting a recording of this webinar. There's loads of useful information on our website about doing a tax return, whether you do that through FreeAgent or whether you do it outside of FreeAgent. Thank you very much for your time this afternoon. I hope all goes smoothly with filling in your tax return. Thanks very much, and bye for now.